Did you know that behind every successful investment decision lies a deep understanding of economic events? From the quiet whispers of recessions to the thunderous roar of inflation spikes, these economic phenomena shape the very fabric of financial markets. But how do these events impact your investments? Join us on a journey into the heart of economic turbulence, where we unravel the mysteries, dissect the strategies, and reveal the secrets to investment success. Get ready to unlock the power of knowledge and navigate through the twists and turns of economic uncertainty. Welcome to a world where foresight meets opportunity. Welcome to Satoshi Finance, where we delve into the intricacies of the financial world to help you navigate through the complexities of investing. In today's video, we'll explore the profound impact of economic events on investments, shedding light on why understanding these events is crucial for every investor. Economic events, ranging from recessions to inflation spikes, possess the power to shape the landscape of financial markets and significantly influence investment decisions. By gaining insight into how these events unfold and their repercussions on various asset classes, investors can better position themselves to seize opportunities and mitigate risks in their portfolios. Throughout this video, we'll delve into the intricacies of these economic phenomena, exploring their implications for different investment vehicles, and equipping you with the knowledge needed to navigate the dynamic world of finance with confidence. So let's embark on this journey together as we unravel the impact of economic events on investments. Economic events encompass a wide array of occurrences that have significant implications for the functioning of economies and financial markets. At their core, economic events represent shifts or disruptions in key economic indicators or factors that influence the overall economic landscape. These events can range from macroeconomic phenomena like recessions and inflation spikes to more specific occurrences such as interest rate changes and geopolitical tensions. Each of these events possesses the potential to disrupt the equilibrium of the economy, leading to cascading effects across various sectors and markets. Examples of economic events abound, with recessions standing out as one of the most impactful. A recession is typically characterized by a significant decline in economic activity, marked by falling GDP, rising unemployment, and diminished consumer spending. Inflation spikes, on the other hand, represent rapid increases in the general price level of goods and services, eroding purchasing power and altering consumer behavior. Interest rate changes, influenced by central bank policies, can impact borrowing costs, investment decisions, and currency valuations, thereby shaping economic activity. Additionally, geopolitical events such as trade disputes, conflicts, or diplomatic tensions can introduce uncertainty into the global economy, affecting investor sentiment and market dynamics. Collectively, these economic events play a pivotal role in shaping the trajectory of economies, influencing policy decisions, and driving fluctuations in financial markets worldwide. Recessions, characterized by a significant decline in economic activity lasting for an extended period, profoundly impact investment landscapes across various asset classes. During recessions, the overall economic slowdown often translates into diminished corporate earnings, decreased consumer spending, and rising unemployment rates. Such adverse economic conditions exert downward pressure on asset prices and increase volatility in financial markets. In the realm of equities, stocks tend to face substantial downward pressure during recessions as companies grapple with declining revenues and profitability. Investors often witness widespread sell-offs as market participants seek to offload riskier assets in favor of safer havens. Similarly, fixed-income securities like bonds typically experience heightened demand as investors seek refuge in more stable assets, driving down bond yields. Real estate markets also feel the pinch of recessions, with property values declining amidst weakened demand and tightening credit conditions. Additionally, commodities, particularly those tied to industrial production such as oil and metals, often see prices plummet due to reduced demand and excess supply during economic downturns. In navigating investment strategies during recessions, investors may opt for defensive tactics aimed at preserving capital and generating returns amidst challenging market conditions. Strategies may include reallocating portfolios towards defensive sectors such as utilities and consumer staples, favoring high-quality dividend-paying stocks, and increasing allocations to safe haven assets like government bonds and gold. Moreover, maintaining a diversified portfolio and adhering to a long-term investment approach can help mitigate the adverse effects of recessions on investment returns. Historical examples of recessions, such as the 2008 global financial crisis or the dot-com bubble burst in the early 2000s, serve as poignant reminders of the significant impact recessions can have on investments, and underscore the importance of prudent risk management and strategic decision-making during periods of economic turmoil. If you've made it this far, consider taking a moment to subscribe to our channel. Subscribing is absolutely free, and you can always change your mind. We have a wealth of financial insights and exciting discussions lined up for you. Your support not only helps us reach a broader audience, but also motivates us to continue creating high-quality content that educates and empowers viewers like you. So, hit that subscribe button, stay tuned, and join us on this journey towards financial empowerment. Thank you for being a part of our community. Inflation spikes refer to sudden and significant increases in the general price level of goods and services within an economy. These spikes erode the purchasing power of money, leading to higher costs for consumers and businesses alike. Inflation spikes can be triggered by various factors, including increased demand, supply chain disruptions, or expansionary monetary policies. The impact of inflation spikes on investment returns can be profound. Inflation erodes the real value of investment returns, reducing the purchasing power of future cash flows generated by investments. Fixed income securities such as bonds are particularly vulnerable to inflation spikes, as the fixed interest payments they provide become less valuable in real terms over time. Similarly, cash holdings suffer from diminished purchasing power during inflationary periods. To hedge against the effects of inflation spikes, investors often employ asset allocation strategies that include exposure to assets with intrinsic inflation hedging properties. These may include investments in real assets, such as real estate and infrastructure, which tend to appreciate in value alongside inflation. Additionally, commodities such as gold and other precious metals are often sought after as inflation hedges due to their historical tendency to maintain value during periods of rising prices. Equities, particularly shares in companies with pricing power or those operating in sectors with strong demand dynamics, can also serve as effective inflation hedges. Examples of investment vehicles that perform well during inflationary periods include Treasury inflation-protected securities, TIPS, which offer protection against inflation by adjusting their principal value in line with changes in the Consumer Price Index, CPI. Additionally, real estate investment trusts, REITs, provide exposure to income-generating properties that can benefit from rising rental income and property values during inflationary environments. Furthermore, commodities such as oil, agricultural products, and industrial metals often exhibit price appreciation during inflation spikes due to increased demand and supply constraints. By incorporating these inflation hedging assets into their portfolios, investors can mitigate the erosion of purchasing power and preserve the real value of their investments in the face of inflationary pressures. Beyond recessions and inflation spikes, various other economic events can significantly impact investment landscapes and pose challenges for investors. Interest rate changes, orchestrated by central banks to manage monetary policy, exert a profound influence on borrowing costs, investment returns, and asset valuations. For instance, when central banks raise interest rates to curb inflation, borrowing becomes more expensive, leading to reduced consumer spending and corporate investment. Conversely, lowering interest rates can stimulate economic activity by making borrowing more affordable, potentially boosting asset prices and spurring investment. Geopolitical tensions also pose risks to investment portfolios, as they can disrupt global trade, destabilize financial markets, and escalate uncertainty. Events such as trade disputes, military conflicts, or diplomatic tensions can trigger volatility in asset prices and alter investor sentiment. Additionally, policy decisions made by governments and regulatory authorities can have far-reaching implications for investors. Changes in tax policies, regulatory frameworks, or fiscal stimulus measures can impact corporate profitability, consumer behavior, and market dynamics, influencing investment decisions and portfolio allocations. In navigating uncertain economic environments fraught with various economic events, investors may adopt several strategies to mitigate risks and capitalize on opportunities. Diversification across asset classes and geographies can help spread risk and reduce portfolio volatility, ensuring resilience against adverse economic shocks. Moreover, maintaining a long-term investment perspective and focusing on fundamental analysis can help investors weather short-term market fluctuations and capitalize on the intrinsic value of assets over time. Additionally, staying informed about economic indicators, geopolitical developments, and policy announcements can enable investors to anticipate potential market moves and adjust their portfolios accordingly. By adopting prudent risk management practices and remaining adaptable in the face of economic uncertainty, investors can position themselves to navigate the complexities of dynamic economic environments effectively. Examining real-life case studies provides valuable insights into how economic events impact investments and how investors respond to and adapt in such situations. For instance, the 2008 global financial crisis serves as a poignant example of how economic events can trigger widespread market turmoil and reshape investment landscapes. The housing market collapse in the United States, fueled by subprime mortgage defaults and excessive risk-taking by financial institutions, precipitated a severe economic downturn, leading to plummeting stock prices and widespread investor panic. In response, investors sought refuge in safe haven assets such as government bonds and gold, while others adjusted their portfolios to reduce exposure to high-risk assets. Analyzing investor behavior during economic crises reveals common patterns and strategies employed to mitigate risks and capitalize on opportunities. During times of market uncertainty, investors often resort to defensive tactics, such as reallocating portfolios towards defensive sectors, increasing allocations to cash or low volatility assets, and adopting a more conservative investment approach. Additionally, active management strategies, including tactical asset allocation and opportunistic buying of undervalued assets, can help investors capitalize on market dislocations and generate attractive returns amidst economic turbulence. Moreover, studying past economic crises provides valuable lessons for shaping current investment strategies and risk management practices. Key takeaways include the importance of diversification, maintaining a long-term investment horizon, and remaining disciplined in the face of market volatility. Additionally, understanding the interconnectedness of global financial markets and the role of central bank policies in shaping economic outcomes can inform investors' decision-making processes and help them navigate through uncertain economic environments more effectively. By drawing insights from historical case studies and applying them to current investment contexts, investors can enhance their ability to anticipate market moves, manage risks, and achieve their long-term financial objectives. In conclusion, we've explored the significant impact of economic events on investments and the strategies investors can employ to navigate through dynamic market conditions. We began by defining economic events and examining their various manifestations, including recessions, inflation spikes, interest rate changes, geopolitical tensions, and policy decisions. We then delved into how these events affect different asset classes and discussed strategies for mitigating risks and capitalizing on opportunities during uncertain economic environments. Throughout this discussion, it has become evident that staying informed about economic events is paramount for investment success. By understanding the implications of economic events on financial markets and asset valuations, investors can make more informed decisions and adapt their investment strategies accordingly. Whether it's reallocating portfolios, seeking out alternative investments, or adjusting risk exposure, staying ahead of economic trends is essential for preserving and growing wealth over the long term. I encourage viewers to continue learning and adapting their investment strategies in response to economic changes. The financial landscape is constantly evolving, and successful investing requires ongoing education, diligence, and flexibility. By staying informed, remaining disciplined, and seeking out opportunities even in challenging times, investors can position themselves for long-term financial prosperity. Remember, the key to successful investing lies not only in understanding economic events, but also in responding to them thoughtfully and strategically. Thank you for joining us on this journey, and here's to your continued success in the world of investing.